Well, greetings and salutations, Series 7 test takers. This is the Series 7 guru coming to you from my studio here in fabulous Las Vegas. We've had a requested lecture. We do honor lecture requests. Might take us a while to get it in the queue and get it done, but this was a request for a lecture on technical analysis. So we are fulfilling that request. If you have any other ideas for lectures that you'd like to see, let me know. So here's what we're going to talk about in today's discussion as it relates to technical analysis. We're going to talk about charts. You know, it's based on the premise that we can have an idea of the future based on past price performance. So, you know, as a technical analysis, I'm doing technical analysis, if there's more demand for the stock than supply of the stock, that's what I'm trying to determine, the stock will go up. And if there's more supply of the stock than demand of the stock will go down. So as a technical analyst, I'm not interested in Apple's products or services, its financial statements. What I'm interested in is the supply and demand of Apple stock. So again, more demand for the Apple stock goes up, and more supply, it goes down. So we're going to talk about the support and resistance line on a chart. We're going to talk about using stop orders to establish either a long position or short position, because as a technical analyst, we don't believe in buying or selling unless there's some kind of a trend. We're looking for confirmation of a trend. You know, we don't want to get on board the train when it's stuck in the station. We don't want to get on board the train when it moves out of the station going our way, important, going our way. We're going to look at a head and shoulders pattern in a chart. We're going to look at a saucer pattern. We're going to look at overbought and oversold. That's more of a vendor thing than it's a test issue, but a lot of vendors have practice questions on it. So we'll talk about that briefly. Theory isn't truth. Theory is just a way of explaining things. The more a theory can explain, that better that theory is. So we'll talk about short interest theory, kind of counterintuitive, but it's a bullish thing. We're going to talk about the inventor of technical analysis, a guy named Charles Dow, and the Dow Theory, which is again about confirmations. That's called classical Dow theory. We're going to talk about odd lot theory. And it's usually the odd lotters are the dumb money, which is the opposite. We're going to talk about how we confirm a market move in terms of breadth of market. And we're going to talk about efficient market hypothesis. The efficient market hypothesis, not a 7 question, but on NASA exams, 65, 66, in the weak form of efficient market hypothesis, technical analysis does not work. All right, so let's get a whiteboard here and let's get started. Now, I always joke, you know, on your test, it'll be the only time the charts look exactly how they're supposed to look. You're not going to be struggling on your exam. Let's get a different color here on where the support and resistance line is. So I'm just going to make a bottom line here. I'm going to make a top line here. And again, what we do as a technical analyst, let's just put this here. Going this direction in our chart is time. And going this way, let me get a different color, is price. Yeah, I was trying to get a different color there. And then as a technical analyst, what I do is, you know, each day I plot the prices, you know, day 1, day 2, Monday, Tuesday, Wednesday, you know, Thursday, you know, Friday. And then what I do is I kind of connect the dots. You know, so there's our charting pattern. And then what I would do is connect those. And I'd get rid of the excess. So there's kind of looking at a chart. Now, I'll use Apple, for example. Apple right now is trading at 143. And the last chart I looked at, let's call that the current market price. And when I was looking at this chart for Apple, it looked like there was some support at 140. That's the bottom line in a chart. It seems like there's some strength there at 140. And as I was looking at this chart of Apple, it looked like there was some resistance. It seems like it's having a hard time breaking through that upper line, which is resistance. As I said on your test, it would be as an exhibit, the only time the charts look exactly how they're supposed to look. As I said, if I'm a technical practitioner, I wouldn't want to buy, Apple while it's stuck in this trading range. What I want to do is establish either a long position or a short position. Again, I'm indifferent whether it's long or short, just as long as it moves, right? So what I'm looking for is what's called a breakout. So let me get my chart here. My eraser doesn't want to cooperate. Anyways, I'll just I'll just wipe out the whole thing. We can do it again. Oh. That's what happens when you do lectures on the fly like Dean is doing here. Okay, so putting back my top line here is 150. That's my resistance. And so what I'm looking for is what's called a breakout. So if we're looking at this chart that I've made here, here's my chart, and it looks like it's going like this. Now, here's the key point, right? At 150, I think there's going to be some momentum. And so what I would do if I think this is going to be the case, if I only want to buy it if it breaks through that. And so what I would do is I would place a buy stop test question above the resistance line. Maybe I put my buy stop here at 153. And I'm telling my broker that if Apple trades at or through 153, I'd like to go long. And so it is testable to know that we're going to use a buy stop. One of the uses, not the only use, but one of the uses of a buy stop order is to establish a long position. And again, I don't want to establish this long position unless it trades at or through. So I'm going to establish my long position here only if it makes a move my way. And as I said, I don't really care whether it's long or short, just as long as it moves, right? So again, I don't care whether it goes up or down, just as long as it moves. And so again, in my chart, again, here's the key point. What happens next, right? And what I want to do is go short if it breaks through the resistance line. So test question, what I might want to consider doing is placing a sell stop, telling my broker, if Apple trades at or through 140, I'd put it typically below that. So I'll put my sell stop at maybe 138. You don't have to actually come, the numbers will be provided to you. But a sell stop, remember, one of the uses of a sell stop is to establish a short position. And again, I wouldn't want to establish a short position unless Apple starts trading through, breaks through its support line, right? My broker says, Dean, you don't have the stock. I say, I know I don't have the stock. He said, well, Dean, if you don't have the stock and that gets triggered, you're going to go short. I go, exactly. That's exactly what I'm trying to do. Now, one of the things that could happen is we could run out of buyers or sellers. We could run out of buyers or sellers. I was just talking to somebody today, right? And I said, well, that's what happens when you run out of buyers. The thing, starts to fall. So as we said, as a technical practitioner, one thing I might be afraid of is I'm looking at my chart and it looks like it's going to break through, but then it suddenly decelerates there and loses momentum. And there's now, we've exhausted the buyers. And that scenario, I said, is more of a vendor issue, but that would be called overbought. Overbought means we've running out of buyers. Overbought. And the test question is that this again would be a signal of a reversal if it's overbought. I mean, there's no buyers left to continue to keep this thing going up, right? Signal of a reversal, which is, by the way, the same thing as a head and shoulders pattern, right? A signal of a reversal. Right. And then oversold would be this one is going to be bearish. Right. It means we're running out of buyers. I'm trying to think of an example outside of our industry, right? It could be anything where, whether it's any item that we're buying at some point, bourbon, for example. We run out of people who are willing to pay $2,000 a bottle for bourbon, and it's going to go the other direction. All right. And we have the same thing going the other direction, right? As we said, we don't really care about, the company itself. What we care about, it again, is Apple, technical analysis, what's going to happen here. So same thing here again. Whoop. Same thing here again. I'm looking at my chart and I'm looking for this thing to go here, but then all of a sudden we run out of sellers. We have all kinds of people selling, and then at some point there's no more sellers, and that's what we say is oversold. Now, counterintuitive again, if we run out of sellers, again, that's going to be a bullish thing, right? So that's going to be bullish, a signal of reversal, because now if there's no more sellers, the thing should start to rise again. So again, more of a test prep vendor issue than a test issue, but overbought means we run out of buyers, and therefore the stock is going to reverse and go down. Oversold, we run out of sellers, and we run out of sellers. That means there'll be more buyers and sellers, and it should go up, right? So again, it's a signal of a reversal. Now, the other patterns you're held accountable for in technical analysis is a head and shoulders pattern. And a head and shoulders pattern is a signal of a reversal. That's very testable. This would be the end of the bull and the beginning of the bear. So a head and shoulders pattern, test question, is a signal of a reversal. This would be the end of the bullish trend and beginning of the bearish trend. And by the way, and as a technical analyst, again, we don't care. We just want to find the trend and catch that trend, right? That's what we're trying to do. We also have, let me get my thing here, an inverted head and shoulders. As I said, it'll be the only time they look like they're supposed to look. And again, signal of reversal. This would be the end of the bear and beginning of the bull. I highly recommend on Friday at 1:30, they have a show called Options Action. And, it's educational. God knows you would lose lots of money following their advice, but they have a technical analyst named Carter, and they always say, call to the charts. And he shows you the charting pattern. If you're trading short-term, technical analysis is going to be more of a tool than fundamental analysis, right? If your option is expiring 6 weeks from today, that's a little different proposition than buying the stock. All right, so we said the other pattern we were going to talk about is a saucer pattern. And again, that's another one that's more of an issue with the vendors than it is on the actual test. But a saucer pattern is, again, a signal of a reversal. What we're trying to do is buy here at the bottom of this saucer pattern as we see it developing, right? So again, another signal of a reversal. All right, so let's go back now. So we talked about support. By the way, test question. A lot of people have sell stops below the support level. So sell stops, test question, can accelerate bearish trends. Which of the following orders can accelerate a bearish trend? And you would say a sell stop, not a sell stop limit, because remember that may or may not go up because you're saying your price are better. And then I would know that a buy stop can accelerate a bullish trend, because a lot of people have buy stops above that resistance line. And when those buy stops get triggered, that can accelerate a bullish trend. We talked about a head and shoulders pattern. We talked about saucer. We talked about overbought and oversold. So the next thing we want to talk about is short interest theory. So short interest theory is counterintuitive, but it says the short sellers can accelerate a bullish trend, because as the stock goes up and it trades through, let me get out my annotation tool. We're got a bunch of people who short the stock. We're using Apple chart, right? Here's our Apple. And we said our support line is 140 and our resistance line is 160. And as the stock breaks out past that resistance at 150, it accelerates that bullish trend, and the short sellers can get squeezed and get maintenance calls and have to buy the cover. Elon Musk at Tesla says he loves squeezing the shorts. It's counterintuitive, but he says he likes to see a big short interest in the stock because, there's not a big public float. There's a much bigger public float now. There is more supply because he sold a lot of it himself. Now, Charles Dow came up with a Dow theory. He invented the Dow Jones Industrial Average. Please note, Tev's question, the Dow is a price-weighted index. It's the only indexes that are price-weighted. And, the Dow theory says that we're trying to again confirm the trend. So there's the Dow Jones Industrial, Dow Jones Transportation, and Dow Jones Utilities. And how Charles Dow said we should confirm a trend, bullish or bearish, is they should all make new highs. For example, if the Dow Jones Industrial makes a new high, those industrial companies must have shipped a lot of product and put salespeople on the road. So transportation would make a new high. They must have used a lot of power. And so utilities make a new high. So if they all make a new high, that's confirmation of a bullish trend. If they don't make new highs, that would be non-confirmation. Technical analysis is about confirmation signals or non-confirmation signals. Most practitioners have their own version, proprietary secret sauce, but this is classical Dow theory. Again, confirmation of the bearish trend would be the industrials make a new low, transportations make a new low, and utilities make a new low. So that's called Dow theory. Odd lot theory says the odd lotters are the dumb money and we should do the opposite. So whatever the odd lotters are doing, if you can't afford to buy 100 shares, there's perhaps a reason. That reason may be that you're unsophisticated and we should do the opposite. Now, breadth of market is how we confirm the trend, right? We don't really, if the market goes up today, but it was only one stock with a huge market cap, did the market really go up? So in technical practice, what I would want to see is like 10 advances for one decline, for example, to confirm that trend. I'd also like to look at the volume. Is it rising volume or falling volume to give me how deep, what is the breadth of that market? And as I said, if I wanted to even out my charts on an index, for example, or a stock, I would use a moving average, and that gives me a prettier picture. I should say a better illustration of the trend. And then I said the test question about efficient market hypothesis is to know that under the weak form of efficient market hypothesis, technical analysis does not work. So, if I'm a believer in the efficient market hypothesis and you tell me you do technical analysis, I'm going what a waste of time and energy and resources. Okay, so I hope that was helpful to you. I have another version of this on the explication of the Series 7 content outline. And when I did that one, before I did it, people said, oh, you don't have anything on technical analysis. And then I made that one and I said, I do. And now I would tell you, when people say, Dean, do you have anything on the channel on technical analysis? I'm going to say, I do. Check it out. Remember, inch by inch, your Series 7 is a cinch. Yard by yard, your Series 7 is hard. I might put this in the 65 playlist and the SIE playlist, just, in case, can't hurt you. There are a couple questions, as I said, that are found on 65, 66 SIE, not to the depth that I just covered it. I'll see you for the next explication. Bye-bye.